Market seems priced for a temporary slowdown, but not recession or boom, points out our next guest. But despite that lingering optimism, hedges against a moderate correction may make sense for the risk-averse and the fully invested. Kristen Bitterly is the head of North America Investments at Citi Global Wealth. Kristen, good to see you as always. Before we get to some of your calls, I think you highlighted something very good in our digital green room just now. Isn't it surprising to see the markets rally off a headline inflation print of 8.5%?
It's interesting because I think when you actually break down this 8.5%, it was in line with expectations, right? So in theory, the market shouldn't be reacting. But now we've all become experts in CPI prints and we're really getting into the details, whether you're an economist or not. And so I think actually breaking down that print, what do we see? Well, when we look at oil, when we look at the price of gas, when we look at the price of food, that was expected due to what's happening in the Ukraine and all of those disruptions in terms of supply chains from a commodity standpoint. But when you get into core inflation, that's where we came in below estimates. And so this idea that some of inflation could be decelerating or that we may be getting closer and closer to peak inflation, that's taking some of the near-term pressure off markets. But keep in mind, one CPI print is not going to change the trajectory of the Fed. So maybe a little bit of ease for markets, but not for the Fed.
And Kristen, you've laid out three potential scenarios here for U.S. economic activity from positive to negative. We have robust, resilient, and recession. I'm wondering, how does this morning's CPI print and the economic data we've been getting most recently feed into any of these three narratives and bolster one of these cases?
I think it basically just increases the probability of resilient, which what we tried to do about 2 weeks ago, we received a lot of questions from investors about what are the potential trajectories from here. A lot of people are talking about a potential recession. And so we tried to break down what are the potential outcomes for markets and for the economy. And we said robust, resilient, and recession. And so robust being at about 20 to 25%, resilient being our base case, and then recession being around 20 to 25%, but something that we wouldn't see out until at least 2023. And so what we're looking at from a resilient standpoint is that we would see growth slowing, but not in negative territory. We're going to see that across earnings growth as well as broader economic growth. And so the key thing here is if we say that the highest probability is either in this resilient market, which we would expect kind of single digit type returns. We're not talking about anything like we've seen over the past couple of years. How do you want to be positioned? And the key there is really quality, both in your equity portfolios as well as your fixed income portfolios.
Even still, Kristen, a lot of folks are waking up right now. They see this red hot inflation reading again, and they see a lot of folks come on with us, talk about increased recession risk. What stocks do you sell in this type of environment, just given all the risks that in many respects are rising right now?
I think so. You could look at it, what do I sell right now or what do I really lean into? And I think the argument here is on quality. And we've been talking about this not just over the past couple of weeks, but really over the past couple of months. This is something that we started in Q4 of last year, where we said this is no longer COVID driven with like COVID winners, COVID losers, any type of quick snapback trade. We want to lean into the parts of the market where you have quality. So these are large cap companies who have taken advantage of the low interest rate environment to really shore up their balance sheet. And they're returning capital to investors in various ways, either through growing their earnings, growing their dividends. And we've seen a lot of action on the share buyback side as well. And so this earnings season becomes one of the most important earnings season because it's going to give you a lot of insight into which companies, especially given the forward guidance, which companies have that durable demand, which companies have that pricing power. And remember that even in decades like the 1970s, where we had extreme inflation, large cap quality US equity shares were able to double their share price over that period. So that's the pocket of the market where we're confidently either staying invested or getting invested.
And speaking of earnings, you've mentioned that first quarter earnings estimates are too low, while estimates for the second half of the year are too high. Starting with the Q1 results we're about to be getting, why do you think there's more reason for optimism than the street is currently pricing in?
And so I think there's more reason for optimism when we look at it overall, right? So you just commented a little bit earlier on the program when it comes to energy and specific sectors that are going to do quite well on the back of Q1. We've also seen a really strong consumer coming into this year. So this idea that some of the economic data that we're seeing from a consumer standpoint, from an employment standpoint, is actually quite robust. So we haven't seen that pullback in demand quite yet. So we could see some nice activity within earnings. And remember, they were revised coming into this first quarter. The key, though, is going to be when does this inflationary pressure really flow through into earnings? And that's going to be in the second half of this year, which again is the pivot within our portfolios towards those larger cap quality companies. And again, I bring this back to both in fixed income as well as equities, who can actually withstand those types of pressures, because there will be pressure, even though we may have gotten a little bit of relief in markets based on the inflation print and what's showing in core inflation. But when food prices are high, gas prices are high, that's driving consumer behavior and are going to impact certain sectors.
Kristen Bitterly, head of North American Investments at Citi Global Wealth. Always good to see you. Have a great rest of the week.